And so we stepped back and said, okay, investors, including me, need a lot more diversification. And investors also need to be, if possible, in the top, investing with the top 50 or maybe even the top 20% of the operators out there. And so I had neither as a multifamily syndicator that didn't like being a landlord or managing people. So we stepped back and started a fund. And the goal with the fund was to provide diversification across different asset types, different geographies, different operators, different strategies.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Paul Moore of Wellings Capital, who's actually a repeat guest. I had him back on the show in 2021, and I wanted to bring him back on the show, one, because our first episode was a great conversation, but two, because he's focusing on a segment of the business that is a really hot topic right now, which is investing in preferred equity. And if you're not familiar with what preferred equity is, we dived into that in this episode. So I'll hold off on discussing that until the actual interview with Paul. But this is something that is being very widely discussed in the multifamily sector right now, and really commercial real estate in general, as it relates to being used as rescue capital, being a method of raising capital that allows you to bring down your blended cost of capital and actually get deals across the finish line. And in general, a lot of folks are looking at either investing in preferred equity on the LP side or raising preferred equity on the GP side. So I wanted to bring on Paul and have a deep discussion about preferred equity, the pros and cons of investing in preferred equity if you're an LP, the pros and cons of raising preferred equity if you're a GP or an operator, and just have a lengthy discussion around preferred equity in general and a lot of the nuances around using that in the capital stack if you're an operator. So I think this is a really timely and topical episode, but one that also is going to be value add at any point in the market cycle. It just happens to be a hot topic right now, which is why I wanted to have this conversation at this point in time. So stick around and give this episode a listen. I'm sure you'll learn something, and I'm sure it'll open your eyes into raising capital in a different manner if you're a GP. And if you're an LP, maybe this is an avenue for you to go and achieve some more compelling risk-adjusted returns comparatively to investing in common equity. And as always, if you enjoy the episode, please consider leaving the podcast a rating and review, or subscribing if you're watching this on YouTube. We are putting all the episodes on YouTube right now, and you can find them by just searching Multifamily Wealth Podcast on YouTube if you want to watch the full video versions. So either subscribe or leave the podcast a 5-star rating and review, depending on the platform that you are consuming this on. But nevertheless, let's get to my conversation with Paul Moore. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me for the second time is Paul Moore. And Paul, I think you were on the last time back in 2021, I believe. So it's been a couple of years, probably more than a couple of years at this point. Two entirely different real estate markets that we're playing in terms of the last time we spoke in our conversation today. So it's going to be interesting in terms of what we discuss and to learn a little bit more about how your strategy's evolved, which I know we'll be getting into. But for the folks that maybe missed that episode a couple of years ago, and if you did miss it, I'm going to link it in the show notes for all the listeners. But why don't we start with your background and share a little bit about yourself, how you got into real estate, and what you guys are up to now?
Yeah, absolutely. Well, it's a super honor to be here again. Thank you so much. And Axel, I'm looking forward to this. So I sold my company to a public firm in 1997, made my first, I thought I was a full-time investor. I was more of a full-time speculator. Didn't know the difference, and I lost a lot of money in the next many years. Made some money along the way as well. But anyway, I did a commercial real estate investment in 99. I did about the next 11 years, I should say, in residential, flipping houses, single family rentals, did some, small multifamily. And in 2011, my business partner and I invested in oil and gas, which was another speculation. But we lost money in that. But we realized there was a huge housing shortage in North Dakota during the Bakken oil boom. And so we went up there and we built multifamily housing. And we were printing money for several years while the oil prices were so high. Then we built a Hyatt hotel, and that got me into multifamily syndication. I wrote a very humbly entitled book called The Perfect Investment in 2016. And then I started going on podcasts, including yours, a few years later, saying, time out. It might not be perfect if you have to overpay, over leverage, and get really, really risky debt. And I had no idea that the bull run would go that long. But of course, the tax law changes in late 2017 helped. But I will say that obviously, like you said, and to your point to where we are today, a lot of those predictions came true. I didn't really know all the reasons. I didn't understand the scope of how difficult some of those decisions would, some of the consequences, I should say, of some of those decisions. But at any rate, we pulled out of multifamily syndication by early 2018, and we started a fund, and we invest in multifamily and other asset types now.
No, that's great. And yeah, I think it's interesting. I remember because I got into this business in early 2016. And I remember getting into it in 2016 and really starting to get going in 2017, 2018, hearing from a lot of folks at that time that there was some trepidation around continuing to aggressively invest, given where it was perceived to be in the cycle. And then next thing you know, you rattle off another 3 years, and then we add all this money into the system in 2020 post-COVID. And yeah, it's interesting to look backwards and to think about the different decisions made along that journey and the amount of folks that got into the game at that point in time, me included.
Yeah.
But an incredible perspective that you have, being in it for 20 plus years and having an interesting well of experience to pull from the types of projects that you were doing. And I know that we spent a lot of time in the first episode a couple of years back. I asked a lot of follow-up questions around, a lot of the investments that you made in the oil and gas space and a lot of the projects that you dove into. So for the listeners, go back and listen to that episode if you want to dive into that a little bit more, I guess, more deeply. But in this episode, we're going to take the conversation a different way. First thing that I want to ask you is, you mentioned you stopped directly investing in multifamily around 2018, and then you started a fund to invest in multifamily and some other asset classes, different investment types. Can you define, just for the listener, the difference there? Because a lot of folks are thinking, okay, you stopped investing in multifamily, started a fund. What are the mechanics there? How is that actually different in terms of what you were doing in 2018 versus what you've done the last 4 or 5 years?
Yeah. So this doesn't apply to everybody, but it does apply to me. I was not a good multifamily syndicator. I don't like being a landlord, and I don't like managing people. Where does that leave me? And so I really felt that I was better at talking to investors and, writing and blogging and doing webinars and podcasts and things like that. And so we stepped back and said, okay, investors, including me, need a lot more diversification. And investors also need to be, if possible, in the top, investing with the top 50 or maybe even the top 20% of the operators out there. And so I had neither as a multifamily syndicator that didn't like being a landlord or managing people. So we stepped back and started a fund. And the goal with the fund was to provide diversification across different asset types, different geographies, different operators, different strategies. And we found out years later, we would add different places in the capital stack, which we're going to talk about. And we also realized that if we did a lot of due diligence, that we could try to get, in that Pareto principle, the top 20% produce perhaps the top 80% of results. And that's what we found. And so that's what we do as a fund. We are not an operator in any deal. And we are on our 6th fund now. And we basically partner with the best operators we can find, and we invest typically common equity in all their deals, but we just added preferred equity, which you and I talked about a little bit a few minutes ago.
Yes, and we're going to be diving into that in a moment, and that's helpful clarification. So, went from being an operator, realized, hey, this is a different skill set. I don't typically love this, and maybe there's a better way to actually participate in this business. So we'll go raise the money, partner with the great operators, and be a capital provider. Which
Right.
it's a great segment of the business to focus on if that's your skill set. And there's plenty of folks out there listening that might realize that actually describes them too. Like,
Yeah.
I'm buying because I think I got to buy if I'm going to raise capital, but you can be a capital partner to other great operators out there and target the business in that capacity. So,
Right.
let's just jump right into preferred equity. And I'm going to preface this just for the listeners here. This is a really hot topic in multifamily and the commercial real estate at large right now, whether it's multifamily or other asset classes, self-storage or retail or what have you. But given some of the dynamics that are prevalent in the overall market right now, a lot of folks using floating rate debt, a lot of people paying prices back in 2021 or 2022 that exceeded what the current market value of those properties are. They're in a position where they maybe need to do cash in refis, or where their debt service coverage is below 1 and they need a cash infusion in order to maintain debt service and to not enter some kind of situation with their lender that's going to put them in trouble. So there's some distress brewing in the business in some segments of the marketplace and the geographical or from a geographical standpoint more than others. Florida and Texas, insurance costs going through the roof. So there's distress, right? Some areas more than others, some operators more than others, et cetera. And preferred equity is a hot topic of conversation as it relates to ways for operators to potentially alleviate that distress or cure that distress as a way of raising capital that doesn't necessarily come in the form of common equity or additional debt. So let's talk about how you view this investment type and how you guys are maybe pursuing pref equity investments right now, and maybe just riff on why you like that as an investment at this point in time.
Yeah, I'll start by talking about 3 or 4 different types of pref equity just to set the stage. But what I want to say first is what it's not. Now, you may be listening and go, oh, yeah, I know about preferred returns. I've got preferred equity. No, it's not. It's a completely different type of equity. So if you have preferred returns or preferred hurdle rate in your offerings, or as an LP, if you're investing in someone's offering, this is totally different. Okay. The different types, we can dive deeper on this, Axel, but the different types would be, number one, it would be development pref equity. And a lot of developers that, when they hit a home run, they hit it out of the park, grand slam. And so they can afford high priced pref equity as part of their capital stack. A second type is acquiring value add deals. And I say value add, it could be any kind of deal, stabilized, whatever, but value add makes a little more sense, as we'll see in a minute. A third type would be at the time of refinance. Somebody's coming up against a refinance and those I can't hit the debt service coverage ratio. I need to, but I'm really close to being able to if I do these certain value adds, or if I put on this addition, or if I do whatever. And then the last type, which is closely related to the refi type, would be rescue capital, which is a little more what you're talking about. And sometimes people are in a situation where a GP is saying, okay, do I do a capital call? And they've pulled their investors and they don't want a capital call. So they say, well, we're going to have to pull the trigger on a different strategy. And that would be putting pref equity between the debt and the equity. So this is what pref equity is. You might have heard of mezzanine debt. Pref equity is similar in that it's behind the debt or above the debt in the capital stack, depending how you're viewing it. And it's ahead of the common equity. That means it has payment priority. It's at a safer, or at least a theoretically safer place in the capital stack. It doesn't have a lien, but often preferred equity gets a personal guarantee from the sponsor. It does have debt-like payments, which are called current pay. And those current pay payments at this time in history can be running 8 to 10 or even 11% current pay. And then it also, like equity though, and that's like debt, but like equity though, it has upside as well. And sometimes that's a compounded 4, 5, 6, 7% more at the time of refinance or sale. So the total coupon on some of the pref equity deals we're seeing are anywhere from 14 to 18% these days. And so that's a quick overview of pref equity. And I can get into some of the reasons I like it if you wish, or I can take a breath.
No, this is great. And I do want to jump right into why you like it right now as an investment vehicle or as an investment type.
Okay.
And I think that it's helpful too, just to define our conversation a little bit more. Vast majority of listeners, value add multifamily space is primarily where they're playing. So just as a context for how we discuss it, I think we'll assume that that's typically the space that the folks are in who are listening to this specific episode. But let's talk about why you like it.
Okay, fantastic. So we like it because it has immediate, and as an investor, now I'm going to get back in a minute to why I would like it as a GP or as a sponsor, but it has immediate cash flow. I mean, my fund invests in some deals that have incredible projected returns, but they're down the road. They're way out in the future. There's a lot of value add to do first, or there's a lot of, there might even be some development components. So, but this provides immediate cash flow to investors. Like equity, it provides a future upside, and it provides a shorter hold time. My funds are, typically 10 years. I like some of our investors would like to have a shorter hold time. It provides a safer place, theoretically, in the capital stack. I say that for my compliance people who will be listening to this. Theoretically safer place in the capital stack because the priority is ahead of common equity. It provides lower downside risk exposure than common equity. If the asset, heaven forbid, loses 25% in value and there's 25% common equity, well, the common equity could get wiped out in that situation. But theoretically, the debt and the preferred equity would not be touched. It still receives depreciation tax benefits. Those are negotiated at the time the pref equity is negotiated. As an investor, I can also negotiate management control rights, forced sale rights, and I can even, do cash management. If it's the kind of thing where the debt service coverage ratio is a little iffy, I can actually, impose cash management, which means we're going to be getting, the cash flow, and then we'll be sending it on over after we get paid. And we can also negotiate reserves, which is super common. So I might have a 2-year pref equity deal and the cash flow might be 9%. Well, if let's say it's $5 million, so that's $450,000 a year in cash flow. Well, I might get the first $450,000 day one as reserves. And if you think about it, if I'm getting $450,000 in reserved cash flow up front, I can reinvest that. I mean, while I'm sitting on that, as every month ticks off, I can leave that money in T-bills and right now get 4 or 5 or 6% extra, not 6, but you get the point. I don't know when people are listening to this, but It's somewhere in the 4 to 5 range at least. So this is an additional bonus. And on top of that, we can sometimes get common equity kickers. Sometimes we can get points, like 1 or 2 points on the front end or the back end. Yeah.
Quickly define common equity kickers, because that's an interesting component.
I should have mentioned that. So a common equity kicker is when we negotiate, we're doing pref equity, but for every $1 million of pref equity, we might get, let's say, $20,000 worth of common equity just as a bonus. So it's a small thing, but it's a little, extra bonus for our investors. One last thing is we can negotiate a MOIC floor, and MOIC would be multiple on invested capital. It really should be MOIE, multiple on invested equity, a floor to potentially increase returns if we're taken out early. For the sponsor, I mean, think about this. Imagine they've got a great team, great track record. They are really dialed in, and they know that this, the value add they're going to do on this is going to work. But they've got a lender who's now saying, yeah, I remember we used to give you 75% LTC. We're only going to get 55% on this one. And then instead of as an operator, they might say, oh, okay, I have to go raise 45% or more in common equity now, but Now I can't because the common equity market has tightened up and they can only raise 25%. So now there's a gap. And so the debt's at 55, the common equity is at 25. The gap in the middle is where pref equity fits. And I believe in that case, it would be about a 20% pref equity slug. So I'm not going to try to do any math past that because I'll just mess it up. But at any rate, think about this. If they can increase the value, and if they can down the road get a supplemental loan, they can take us as pref equity holders out in, let's say, 2 years. And now all the common equity and the GP get that extra ownership. Or if the GP has another deal they're closing in a year or two and they want to use that cash to take us out, now the GP gets to capture that extra, that extra 20% in this case. So it's a really potentially very good situation for the GP if they're confident and if they're capable. And of course, that's the only type of people that most of us would want to invest with. So these are some of the reasons I think it's a benefit to investors and to sponsors as well. And I think there's a very short time window. I don't know how long yet that this will be most relevant, but I'll take a break.
No, that's great. And I'm glad you dove into the specific components of actually structuring a pref equity deal, both on your side as the provider and then also on the operator's side, because I was going to ask you a bunch of follow-up there. So that was great. And to summarize, and then correct me if I'm summarizing incorrectly, but for the folks listening, benefit to the pref equity investor, the provider, which would be you and your group in this situation, right? In this hypothetical, risk-adjusted returns a little bit more compelling because you're treated preferentially to the common equity investors. You can structure the deal in such a way with the operator to further protect your downside or to provide some further upside through some of the common equity kickers. And then obviously all the other components of the actual investment itself that you just described. Benefit to the operator here. It's a mechanism to reduce their blended cost of capital through debt and their common equity. If they have a deal that's extraordinarily compelling, they can capture a little bit more of the upside in this situation versus raising the entire equity requirement from common equity investors and therefore sharing a larger percentage of the upside. And it's a way in which they can structure a deal that actually allows them to get it across the finish line too, just actually raising the capital as well. So there are benefits to both sides here, of course. Now, as a provider and as somebody that's deploying capital in this position in the capital stack, are there attributes that you're looking for in specific deals, whether it's the risk profile of a deal, the geographical area that the deal is in, operator, like what's the perfect pref equity investment for you as the individual that's looking to invest in pref equity?
Yeah, I really believe that the very best investments are made with the best people. Warren Buffett said you can't do a great deal with a bad operator or a bad person. And so we're looking for people who have a very experienced team, a great track record. They've, often they've successfully maneuvered through other difficult situations and come out well. We're looking for teams like that. And we're looking for, a reasonable underwriting, and of course, nobody would say this today, but, a year ago, people were saying, yeah, the rents in Tucson have gone up 18% a year, 3 years in a row. So we're assuming only 10% for the next 3 years. Well, hopefully, we're not going to believe in that. We're not going to believe that story. So they're going to have a good story. They're going to have a very clean background check, reference check, criminal, checks and all that stuff. They're going to have great references from their lender. They're going to have to, we're going to go on site and visit them at their headquarters. We're going to go in, sometimes announced, sometimes unannounced, to the asset or other assets. We're going to do a deep dive on Google. We're just going to do a ton of due diligence. We do an NOI audit on maybe it's if there's another asset attached. Sometimes people attach another asset or a personal guarantee, which I mentioned before, and we'll do an NOI audit to make sure that, to prove the net operating income is really where it's, flowing where they say it is, and a whole bunch more. So that doesn't exactly answer your question, Axel, but we are really focused on the sponsor.
Gotcha. And I'll ask you a couple follow-ups to further narrow down. Is the primary objective to deploy in deals that are active? So sponsor bought a deal a year ago or for example, just a hypothetical here, they're working through their business plan, they actually have some trailing financials you can look at, or is the preference to pursue deals that are under contract on the buy side?
Yeah, so we have invested, I'd say about a third of the deals we've invested in have been existing deals where one was just, all GP equity. There was no common equity as well at all. And then then the other 2/3 or so have been acquisitions of value add deals, almost always multifamily.
Gotcha. And from an underwriting standpoint at the deal level, is the goal to find a deal that returns, call it, some level of a yield on cost that exceeds the debt constant, or just whatever the interest rate is on the debt that allows them to stay current, to meet that? Obviously, each individual pref equity check is probably structured differently, and as it relates to the current pay and then the accrual. Is the goal to find something that's producing cash flow that can support a 7-8% current pay throughout that period of time, and then therefore maybe core low cap rate deals are not necessarily the focus comparatively to secondary, tertiary, higher cap rate deals? Is that typically the focus?
Yeah, our underwriters on our team, we got two who are really better suited to answer a lot of that, but I know they're looking very closely at the current debt service coverage ratio, and then they're sometimes reserving or even doing the cash management based on how long it will take to get above, like a 1.2 global debt service coverage ratio. When I say global, I mean the debt plus the current pay portion of the pref equity. Obviously we want to see it well north of 1.2, but day one, especially in a fairly steep value add deal, it might not be. And that's when the reserves and the management controls and all those type of things would be much more stringent on our part.
Gotcha. Now I have a bit of an interesting question. Let's put ourselves in the shoes of an LP, a common equity investor who invested in a deal, call it a year ago. There's a little bit of distress in this deal. The sponsor's looking to bring in preferred equity to help them get through the refi and to avoid a capital call. If I'm an LP here and that's the situation I'm in, and my sponsor tells me that they're bringing in pref equity, what question should I be asking them to learn more about the mechanics of that pref equity and how it's going to affect me, as a common equity LP?
Yeah, the first thing I think I would ask, I've never been in this situation, but I think I would say, time out. Why didn't you do a capital call? And I mentioned an example earlier where they didn't want to do a capital call, but think about this. And I'm probably going to irritate some people, but if I'm a GP and I'm trying to raise money for 3 more deals next year or next 5 years, and hopefully raise money for decades to come, I might really resist doing a capital call for the PR. I might all of a sudden distributions are slowing down or stopping, and now a capital call. I'm going to get, again, I've never been in either side of those situations, but I think as a GP, I would probably get shredded online. And, those,
I think that's a big
online
fear.
forums.
Yeah.
It's a big fear. So I'm going to think, well, maybe. And some people, and again, some cynical folks on Twitter would say, oh, this is just a sneaky capital call. You're calling capital from a third party and you're inserting them in front of the LPs. And if things go south, the LPs are going to take even more of a bath than they would have if you hadn't done this. So I would be asking the GP, hey, wait a minute, what have you tried doing a capital call? Why not let all of us fund 12% or 20% more than we already invested and get a better stake in the deal if I really believe in you? And of course, if I don't believe, if as an LP investor, if I don't believe in the GP, and a lot of them are cynical right now, I've heard, I don't know what I would think. I think I would just be even more frustrated than I was when distribution stopped.
Yeah, I think I'm asking you a hard question. I
think it is hard.
Yeah, because I think you want, if you're an LP, you're trying to think, well, I'm not too thrilled about maybe somebody coming in ahead of me in the capital stack, but if this is a if this is a measure that's going to help protect my investment, let's understand all of the dynamics here and the mechanics. And I guess a lot of the questions that an LP should ask is, all right, well, let's discuss the terms of this pref equity, right? Was it, did you sign up and take a check with some predatory terms here where I'm really significantly diluted and it's going to take a very successful project to pay the debt, pay the pref equity, and then leave any, after that? Or is it on the other end of the spectrum? So I think if you're an LP, it's probably good to just have those conversations. But yeah, I think a lot of folks, as you described, are too afraid to even broach the subject of a capital call with their investors because of the associated PR. So they're just like, I'm just going to go this route to solve that problem, which is not necessarily the right decision. But I think that's probably going to be happening quite a bit throughout the next 12 months.
Right.
Now, as a provider, as somebody that's investing in this position in the capital stack and extending pref equity to sponsors and operators, what's the ideal length of time that you're in that deal, that the pref equity is in that project before it's taken out? Like, is there an ideal time frame that you guys would like to be in the deal before you're paid off?
So we're a 10-year fund, and I can't, for compliance reasons, get into a lot of detail about that, but we could go 10 years, and but most of the pref what's that?
I said, I feel like that would be a surprising outcome if you were in a deal for 10 years as a pref equity provider.
Yeah, I think it would be too. A lot of the pref equity comes in behind agency debt. And so coming in behind Fannie or Freddie debt would mean that we would likely be coterminous with that debt. So we would have to, with the Fannie or Freddie agency debt. And so we'd likely have to sign up for whatever time frame is left on that agency debt at the longest. And I know we are in one right now that could go as long as 2031, but the operator is convinced, and we believed them when we visited them and saw the underwriting and saw their story, that they would probably take us out in more like 2 years. So I'm usually hearing pref equity providers say they'd like to be out in 2 to 3 years.
Yeah, that makes sense. And I think if you're an operator, that should be your objective, right? You there shouldn't be a situation in which you're in a pref equity deal in terms of you have pref equity in your deal at call it market terms, unless it's actually very advantageous to you as the operator, but assuming it's market terms and market rate negotiated for a long period of time, because there is an associated drag on the deal that it can have if you're in that situation for an extended period of time. So I think it does make sense for value add, right? We have some kind of loan at acquisition, and there's going to be some capital event, whether it's a sale or a refi in the next couple of years. Now, obviously, you want to avoid a situation where you're throwing good money after bad as somebody that's investing in pref equity. There's some deals that are probably irredeemable, and however that's defined. And I'm asking you another underwriting question, I guess, here. Obviously, again, there are a lot of great operators that would probably pass the due diligence that your team does from a background check standpoint, from an experience standpoint. But sometimes, one in every however many deals just doesn't necessarily work out. What are some signs that maybe this is a good money after bad? And I know that's a harder question to answer, but
no, is
there some things you're specifically looking for from a bullet point standpoint there?
Yeah, I'm pulling up my graph here to make sure I quote this right. So we looked at 247 investment opportunities in a 6-month period ending August 15th. And if you're listening later, it's 2023. We passed on 242 and we invested in 5. And so we have a lot. I mean, Warren Buffett said the best investors say no a lot, but the very best investors say no almost all the time. So we have a lot of reasons to say no. I mean, I could just tell you, we could spend the rest of the show talking about that, but I can tell you, here's a couple examples. We had one we were talking with, and it turned out they probably had mob ties, and we just did not like that. And we were able, there were other things, and we were just like able to say, hey, I don't think this is going to work out. That's kind of not the best example. Another example was there was a great operator. He had $30 or $40 million net worth. He was a great apartment operator, but his team, he had done most of it sort of bootstrapping without a really cohesive team. And so when we gave them our very, very, very long list of items they needed for due diligence, they weren't able to come up with a lot of it. I mean, a simple example was there were like 30 properties in a previous portfolio he was going to use as collateral, and he couldn't find appraisals on like 8 of them. And we're like, you couldn't find the appraisals? Yeah, I just can't find them. And so it's like, we were just like, you're an amazing operator. We had done a, on-site visit with 2 of our team members. We really like you, but we think you probably ought to just give it 3 or 4 more years to get a really good cohesive team, hire a CFO instead of a outsourced accountant or whatever. And so we passed on that one. Another one, there was some other dynamics, I will say, but they kept changing deal terms along the way, and they kept, this was a Fannie or Freddie type deal, and so they kept changing this, changing that. We do background checks pretty thoroughly, and this was a mobile home park. The park itself was what we were investing in, but they also had another loan on the mobile homes, and that's called a chattel loan, I believe.
Huh.
And that loan was done by a guy who had been in prison for fraud, financial fraud. And we're like, time out. And we had done that background check on them. And that's not something you would usually think about doing in due diligence, but we do. And I'm glad we did, because we said, time out. We don't want to invest alongside them. We just don't know what could happen. Well, we got through that hurdle. And at the closing table, and we had wired the money, and we even made the mistake of giving our investors a detailed email telling them, congratulations, we just invested in this property, adding it to the fund. At the closing table, they literally tried to change the terms after 5.5 weeks, and everything was signed except the closing documents. And we just said, that's it, last straw, we're out.
Yeah, too many red flags at that point. That's just
yep.
At some point it's a tsunami wave. No, that's the mob ties one. That's so funny. I could probably ask you a bunch of follow-ups on that. I won't, but that's an interesting one. I mean, a lot of this comes back to, as you mentioned, you just have to work with the right people. And I think the big challenge is that over the last 3-4 years, there's been so much exuberance as it relates to getting money into real estate. And there's been so many individuals that have stepped into the arena that's part of the process has been lost in the overall process of doing due diligence, whether you're investing in pref equity, whether you're a common LP investor, whether you're an active operator looking to JV with another active operator. A lot of the conversation goes right to the deal and not about the partnership or the operator. And I think now more than ever, that's going to become really important, because it's easy to do the right thing when everything's going well. I think when things are not going well is when it's a little bit harder to do that, and people's true colors are shown. So I think that's a great closing piece of advice and a tip. Now, last thing, just as it relates to you guys, in case we have an operator listening that is that extremely experienced individual that does think that they might actually have an overlap with what you guys are doing. Typical check size, share anything about who you're looking to invest with, check size, all that fun stuff. Plug
most of the investors in pref equity and JV equity out there are trying to do 10 million up to, maybe 50 million. Well, we decided we would go in at a smaller level, and this would give us an advantage. Number one, less competition. Number two, we'd have way more opportunity to negotiate the terms that would be favorable for our investors. And number three, we could get a much higher coupon rate. And that's true. We have generally been doing deals in I think most all of our deals have been like 3.5 to 6 million. I would say generally, if we're going to do below 3 million, like 1 or 2 million, that would have to be a serial deal, like one of, let's say, 10 multifamily acquisitions in the next year. Maybe it's a series they're buying. But we would generally want to be in the, let's say, $1 to $7 million check size.
Perfect. That's great. Well, Paul, this has been a great episode. And I think a lot of folks are going to take away something new as it relates to how they can integrate this into their business, whether they're on the operational and the sponsor side, or whether they're an investor that's looking to pursue investments that offer more compelling risk-adjusted returns than just throwing money into common equity and running the same playbook back, so to speak. I think this is a really interesting investment vehicle. So why don't you share where people can learn more about what you guys got going on? And I know you have a couple of causes or a cause that you'd like to discuss as well. Please share a little bit more about that, and then we'll wrap up.
Yeah, people can reach me at on Twitter at Paul Moore Invest, and then they can come to my website and get free special reports on a lot of different items at wellingscapital.com. But Axel, I was shocked. A lot of people have heard about human trafficking this year because of a movie that just kind of took America by storm called The Sound of Freedom. But before that, I found out when I heard about it, it was from another documentary that was filmed 11 years ago called Nefarious. It's not the Nefarious that's out this year. It's another one. But basically, I learned from that if you took the record annual profits, not the average, the record annual profits up through 2021 at least of Apple, Nike, General Motors, and Starbucks, added those record profits together, doubled that number, that would be the approximate profits from human trafficking every year. And this is a human tragedy. Yeah. We have more slaves in the world right now than any time in world history. And it's shocking. It's horrifying. And it seems like there's not much we can do about it. I don't know what to do. Am I going to go on a SWAT team raid in Cambodia? Probably not. Am I going to send money to somebody I don't really know what they're going to do with it? Might not want to do that. Well, we decided we're going to do due diligence on nonprofits that try to address this problem. We wanted to find somebody who rescues children, who gives them a safe home, who rehabilitates them, gives them counseling, clothes, food, shelter, and job skills, especially that, to get them away from the situation they were in so they won't go back into it. And so we have found an organization. We have a number we like, but we have one that we really want to promote. It's called AIM, AIM. Their website is aimfree, AIMFREE, aimfree.org. We have raised or donated or influenced $485,000 in giving to AIM over the last 3 years. And we're doing that again this Giving Tuesday. So we're looking for wonderful sponsors or operators or people who have a little extra money to help us put up together a match, which would be a matching fund. If you want to reach out to me and let me know if you'd like to be part of that. We just got a $25,000 matching anonymous donor today. And so very excited about that. Most of the folks come in at $1,000 to $5,000. And then on Giving Tuesday, we're going to do a big campaign where people can give, some of them give $25, some give $100, and our goal is to raise $100,000. So at any rate, thank you for letting me share that.
No, that is incredible. First of all, congratulations on just the sheer volume of funds $485,000 is an incredible amount of money, and that's extremely impactful. And I'll certainly link aimfree.org there in the show notes. I did not realize that the stat as it relates to the volume of that industry, that's probably going to blow a lot of people's minds that are listening to this right now. That is incredible. And what a great cause. So I'll be sure to link that. And if you're listening and you want to go check it out, please do so. And I appreciate you sharing because that's incredibly impactful. So Paul, this has been great. Thanks again for coming on. And for all the listeners out there, go back and listen to the first time that Paul joined the podcast back in 2021. We spent a little bit more time on his story and his background as well. I'll be sure to link that episode in the show notes. But Paul, thanks again for taking the time.
Axel, it's been a real honor to be here. Thank you.